This is a Volkswagen, a Golf specifically, the most manufactured car in European history. 45 million of these vehicles have rolled off German assembly lines since 1974. Every one of them represents German engineering, German precision, German workers assembling German parts into a product the world wanted to buy. Last month, Volkswagen announced they would close 3 German factories for the first time in the company's 87-year history. 30,000 jobs eliminated. Not outsourced, not relocated, eliminated. The production lines that built the German middle class are going dark. Volkswagen isn't alone. BASF, the world's largest chemical company, has shuttered production lines in Ludwigshafen and moved capacity to China. ThyssenKrupp's steel division is bleeding cash and considering a breakup. Siemens has frozen hiring across German operations. The industrial giants that made Germany the manufacturing capital of Europe are contracting simultaneously, for the same reasons, with no recovery in sight. But here's what the business press isn't connecting. Every factory that closes, every production line that goes dark, every worker who loses their job, they all have loans, mortgages, credit lines, working capital facilities. And those loans sit on the balance sheets of German banks that are already the weakest in developed Europe. On January 22, 2026, the European Central Bank released its quarterly banking supervision report. Page 34 contains a chart that should be front-page news in every German newspaper. Non-performing loans at German banks have increased 340% in 18 months, from 24 billion euros in June 2024 to 106 billion euros today. The manufacturing collapse isn't just destroying German industry, it's destroying the banks that financed it. And when both pillars crack simultaneously, what's left isn't recession, it's structural transformation, the permanent end of the economic model that made Germany Europe's engine. Here's what they're not telling you. Germany's banking system was fragile long before the manufacturing crisis began. It never properly healed from the 2008 financial crisis. It never consolidated the way American and British banks did. It never built the capital buffers that would allow it to absorb the shock now arriving. The German banking landscape is uniquely vulnerable because of its structure. Unlike the United States, where 5 megabanks dominate, Germany has over 1,400 banks. Hundreds of regional savings banks, Sparkassen, serve local communities. Dozens of cooperative banks, Volksbanken and Raiffeisenbanken, serve specific industries and professions. 2 large commercial banks, Deutsche Bank and Commerzbank, compete for corporate business while struggling with legacy problems that have persisted for 15 years. This fragmentation was supposed to be a strength. Local banks understand local businesses. Regional institutions keep capital circulating in regional economies. The system was designed for stability, for resilience, for the kind of relationship banking that mass market institutions can't provide. But fragmentation has a cost: inefficiency. German banks are the least profitable in developed Europe. Return on equity at German banks averaged 2.1% in 2024, compared to 9.3% in the United States and 7.8% in France. Low profitability means thin capital buffers. Thin capital buffers mean limited ability to absorb losses. Limited loss absorption means that when a shock arrives, it doesn't take much to push institutions from stressed to insolvent. The shock has arrived, and it's hitting the banks that can least afford it. The Sparkassen, those community savings banks that seem so quaint, so local, so disconnected from global finance, hold 340 billion euros in loans to German small and medium enterprises. The Mittelstand, the family-owned manufacturers and suppliers that form the backbone of German industry. The companies now facing energy costs 3 times higher than competitors in America and China. The companies losing orders as automakers cut production and chemical plants relocate. When a Mittelstand company fails, its Sparkasse absorbs the loss. When enough Mittelstand companies fail, the Sparkasse itself becomes distressed. And when enough Sparkassen become distressed, the regional banking system that funds 60% of German business investment begins to freeze. This is where the lie becomes unsustainable. To understand why German banking weakness matters beyond Germany, you need to understand how deeply German banks are embedded in European financial infrastructure. Deutsche Bank is a global, systemically important bank, one of 30 institutions worldwide whose failure would threaten global financial stability. It has 1.3 trillion euros in assets, 42 trillion euros in derivative exposures, and counterparty relationships with every major financial institution on Earth. When Deutsche Bank's credit default swap spreads widen, as they have by 180 basis points since October, it's not just German risk being priced, it's contagion risk. At 4:15 a.m. Frankfurt time on Wednesday, Deutsche Bank stock touched €7.43, its lowest level since the depths of the 2020 pandemic. The market capitalization of Germany's largest bank is now €15 billion. For context, JP Morgan Chase is worth $580 billion. The entire German banking sector combined is worth less than a single American regional bank. These valuations reflect what the market believes about German banking's future: that non-performing loans will rise further, that manufacturing exposure will generate more losses, that profitability will remain structurally impaired, that the eventual reckoning, whether through failure, forced merger, or government rescue, will destroy shareholder value. But shareholders aren't the primary concern. Depositors are, bondholders are, counterparties are. The institutions that have lent to German banks, traded with German banks, and cleared transactions through German banks are now recalculating their exposure to a system that might not survive in its current form. The European Central Bank's supervisory report identified 47 German banks that failed to meet minimum capital requirements under stress test scenarios. 47 banks. The ECB didn't name them. That would trigger the very bank runs they're trying to prevent. But they acknowledged their existence. They acknowledged that nearly 4 dozen German financial institutions are one bad quarter away from regulatory intervention. When regulators admit that dozens of banks are in trouble, the number is probably higher. The incentives always point toward understatement. When manufacturing collapses and banks weaken simultaneously, the feedback loop accelerates everything. The German manufacturing crisis isn't causing the banking crisis, and the banking crisis isn't causing the manufacturing crisis. They're causing each other, in a doom loop that neither monetary policy nor fiscal stimulus can easily break. Consider how the loop operates. A factory faces higher energy costs and reduced orders. It draws on its credit line to cover operating losses. The bank funding that credit line sees the company's deteriorating financials and tightens terms. Higher rates, more collateral, shorter duration. The factory can't afford the new terms. It cuts production, lays off workers, defaults on supplier payments. The suppliers, facing their own cash flow crunch, draw on their credit lines. Their banks tighten. The cascade continues. At the same time, the laid-off workers stop making mortgage payments. Their Sparkasse absorbs the delinquency. The Sparkasse, facing rising losses, reduces new lending to preserve capital. Businesses that would have expanded can't get financing. The economy contracts further. More workers lose jobs. More mortgages go delinquent. This is the reflexive spiral that destroyed regional banking in the American Midwest during the 1980s farm crisis. It's the spiral that hollowed out British manufacturing regions in the Thatcher era. It's a pattern that's been documented, studied, and warned against, and it's now operating at full speed in the heart of Europe. At 9:30 a.m. Berlin time on Thursday, the German government convened an emergency meeting of the Financial Stability Committee. The attendees included the finance minister, the Bundesbank president, the head of BaFin, the financial regulator, and representatives from the deposit insurance schemes. No statement was issued afterward. The silence is the statement. Less than 45 days remain before Germany's regional banks must publish annual results for 2025. Those results will reveal the extent of the damage from the manufacturing collapse. They'll show loan loss provisions that dwarf previous years. They'll show capital ratios eroding toward regulatory minimums. They'll show institutions that were marginally viable in 2024 becoming clearly unviable in 2025. The annual reports will force decisions that have been deferred for months. Mergers, recapitalizations, government support, or, for the weakest institutions, resolution, the orderly wind down of a failed bank under regulatory supervision. Germany has never experienced a systemic banking crisis in the post-war era. The systems for managing one, the deposit insurance funds, the resolution mechanisms, the political will to deploy taxpayer money, have never been tested at scale. February's annual reports will begin that test. While one side weakens, the other side withdraws. International capital is not waiting for the annual reports. It's already leaving. Foreign holdings of German bank bonds have declined by €89 billion since January 2025. Investors who held German bank debt as safe European exposure have reconsidered that assumption. They're selling to German institutions, insurance companies, pension funds, the banks themselves, who have nowhere else to put euro-denominated capital. The selling pressure remains manageable only because trapped European capital has limited alternatives. More concerning is the deposit flow data. German banks have experienced net deposit outflows of €34 billion in the past 6 months, not from retail customers, Sparkasse deposits remain stable, protected by deposit insurance and customer inertia. The outflows are from corporate treasurers and institutional investors who can move money across borders with a wire transfer. They're moving it to French banks, Dutch banks, and increasingly to money market funds domiciled outside Germany entirely. When sophisticated depositors flee, it's a leading indicator of stress that retail customers don't perceive. The corporate treasurer at a Munich manufacturer knows things about their bank that a retiree with a savings account doesn't. They know which credit lines are being quietly pulled. They know which relationship managers are suddenly unavailable. They know the difference between a bank that's managing through difficulty and a bank that's managing toward failure. 34 billion in outflows suggests the treasurers know something. This is what the end of an economic model looks like. Germany built the most successful manufacturing economy in modern history on 3 pillars: cheap Russian energy, open Chinese markets, and a domestic banking system that recycled trade surpluses into industrial investment. All 3 pillars have cracked. Russian energy is gone, permanently, politically, irreversibly. The gas that made German chemical production competitive, that heated German factories affordably, that powered German industry at half the cost of competitors, that gas now flows to China through pipelines that bypass Europe entirely. German industrial electricity prices are 340% above 2020 levels. They're not coming back down. Chinese markets are closing. Beijing's Made in China 2025 policy systematically replaces German imports with domestic production. German auto exports to China fell 31% last year. German machinery exports fell 24%. The market that absorbed German production is now producing its own goods, often using German technology transferred during decades of partnership that Berlin now recognizes as strategic naivete. The banking system is the 3rd pillar, and it's cracking under the weight of the first 2. The loans made to finance factories that can't compete with Chinese costs. The mortgages written to workers whose jobs are disappearing. The credit lines extended to Mittelstand companies whose business models assume energy prices and export markets that no longer exist. Some will look at German troubles and see a cyclical downturn. Will trust that Germany has weathered recessions before. Will assume that the engineering prowess and work ethic that built the economic miracle will rebuild it again. These are the same voices that said German energy dependence on Russia was manageable, that said Chinese market access would remain open, that said manufacturing could adapt to higher costs without fundamental restructuring. The voices were wrong about the inputs. They're wrong about the outputs. Others will recognize what the numbers reveal. A banking system with 106 billion euros in non-performing loans and 47 institutions below capital minimums. A manufacturing sector losing 30,000 jobs at a single company. A doom loop where industrial decline feeds banking weakness, feeds industrial decline. A structural break, not a cyclical dip. The informed are not predicting German collapse. Germany remains wealthy, innovative, and institutionally capable. What the informed recognize is that the model that generated that wealth, the manufacturing export banking triangle, has broken. That the transition to whatever comes next will be measured in decades, not quarters. That the banks financing the old model cannot survive its demise without transformation that German politics has proven unwilling to force. This is not financial advice. This is not a recommendation to short German banks or avoid German assets or take any position based on manufacturing data. This is simply an observation about what happens when cheap energy disappears, export markets close, and the banks that finance the old economy discover their loans were underwritten against a world that no longer exists. The Volkswagen rolling off the assembly line looks the same as it did 5 years ago. Same engineering, same precision, same German quality. But the factory building it is closing. The workers assembling it are losing their jobs. The bank that financed the supplier is writing down its loans. And the system that connected all of them, the system that made Germany the manufacturing capital of Europe, is coming apart. Not crashing, not collapsing, coming apart. Slowly, steadily, in a way that annual reports will document and politicians will deny until the documentation becomes undeniable. 45 days until those reports publish. 45 days until Germany begins to understand what the banking system already knows. The model is broken. The only question is what replaces it. And right now, nobody in Berlin has an answer.